All right, so when we're considering what the large institutions are doing and how to operate and engage in the foreign exchange market, the premise I want to begin my trading with and my analysis with on the weekend is what I think the weekly chart's going to do. And I sit down on my weekly chart and I look for areas that are obvious. Okay, what do I mean by obvious? Years ago, I taught that if you find a level that's too clean, okay, and it's this too straight edge, chances are it's probably going to get swept. What do I mean by that? Well, if you look at this area right here, notice how this candle goes to that low, the body stops here, the body stops here. It doesn't really have any kind of jagged end or bottom to it, just real smooth and clean. Just like this high and this high has a relatively clean level up there. And these two candles here have a really nice clean level to it. And these right here are pretty much the same thing. But my eye jumps to these levels. The significance about these levels is that below this level here is sell stops. Traders that went long here, they had stop loss orders to protect that long in the form of sell stops. So this level in here is saturated with willing participants that want to sell at the market, because their belief is if it goes below this level here, they're probably wrong in their long idea and they want to get out before it causes them to lose more money. Conversely, there are traders that will see this level as support, and if it breaks, their idea is, well, support's broken, so it's probably bearish, and they want to go short. So how do you go short? You sell. So the function of the liquidity that rests below these smooth or clean equal lows is sell side in nature. So it's sell stops or sell side liquidity. The market last week, July 27th, 2021, the market trades down and sweeps below these clean candles. Okay, so this area here gets attacked. And notice it comes off that low and closes here on the week. The week at present, we opened here, had a small little movement below the opening of the week, and then we had this movement higher. Now, prior to this candle closing up here, we didn't really know if it's going to go down there and continue going lower or if it's going to reverse. That's not necessary. To find profitability in consistent setups, all we're looking for is runs on liquidity. Okay, so you have to know where the draw on liquidity is, and that's what I'm showing you here. This is what you're looking for. Areas that are too clean that may draw price up into them or down into them. So just the opposite of what we saw down here, what would be resting above these relative equal highs? Buy stops. Anyone that was short, how will a trader protect his bearish position? With a buy stop. So any movement above here that would trigger buy stops on shorts, and or some traders that see this as resistance, if it breaks that, they would see it as what? Resistance broken, therefore bullish. So this is the closest draw on liquidity that's opposing this. So when we started the week here, we opened, traded down just a little bit, and started to trade higher. Where's it likely to go? Right above these highs. Doesn't mean it will absolutely do it, but this is what we do. We look for areas where the draw on liquidity acts like a magnet to attack and absorb the liquidity, which rests in the form of buy stops. Institutional order flow for the week should be bullish until we get up into this area. At that moment, we'd have to reassess everything, continuation if it's likely, or reversal if it's likely, or just consolidation. But we don't need to know that right now. So the inability for a price to make a significant price run lower is the tip-off that we're going to see institutional order flow or bias or trend or momentum to the upside until we get into this area right here for the purpose of attacking this buy side liquidity pool for the buy stops. So if we zoom in here, I want you to think about the weekly range in the context that the open and decline from the opening price anywhere in this area close to the opening price or below it is ideal for going long. This is the cheapest it's likely to get. And the closest you can buy around that opening price, the better. As we get closer and closer to this area up here, the idea of probability or low risk starts to dissipate because we have the likelihood that this could retrace back in this range. We're going to drop down to a daily chart here. You can see Monday's trading, July 26th, 2021. And then Tuesday's trading, daily range. And notice how Monday we had a nice little rally higher, and on Tuesday we opened here, and then we traded down into this candle right there. This candle is what I teach as a bullish order block. The market's already bullish, or the underlying narrative is bullish, and we had a confirmation the market wants to go higher. On Monday it trades higher. On Tuesday we trade down into that level. The opening price hits it, trades off of that, rallies back through, and makes a higher high than that of on Monday. Remember, the candle opens here and then trades down. This is a Judas swing. Retail traders get caught up in that on the lower time frame. They think it's bearish and they start selling short. And then when it hits a higher time frame level like this, that's key or significant, it will reverse and start to trade higher, and it catches them off guard. Dropping down to an hourly chart, this level is that same bullish order block level. Notice how the hourly chart trades down, hits it, rebounds, and starts to trade higher. This is that area where the buy stops are. This level and higher is where those buy stops reside. Zooming in here, and I want you to look closer. Think about what I was showing you on the weekly chart. Those clean levels, well, there's singular candle lows and highs, or swing point highs and swing point lows, or swing lows and swing highs. They have stops above and below those as well. This candle right here is a case in point. We have a swing low, a single candle that has a higher low to the right and a higher low to the left. One single candle there, that swing low, is going to be seen as a short-term swing low where sell stops are sitting right below that because the market's rallied up, consolidated, rallied again, and when it's up in here, all in this consolidation, those that bought down here or even over here, they have their stop loss trailed right below that low. And the market drops down to take those participants out and then rallies. Why is it going down there? To accumulate sell stops. Why are they attacking the sell stops? Because this is attacking participants that are willing to sell at a lower price. Lower than what? When it was up here. Institutional traders will not buy up here. They're going to wait for it to drop down to attack a very deep discounted price and pool of liquidity of sellers that want to sell at a cheap price because they trail their stop loss up there. So these sell stops flood the market with sell orders, and smart money buys them at the market. So it goes right in here and buys them. So this is called pairing of orders. The market hits this and then price rallies. Now this is that same swing low, but I'm drawing your attention to these consecutive down close candles because this is a bullish order block, the high to the opening price. Now why not the entire range like a supply and demand zone would be? Well, this is not supply and demand. So it's the high down to the opening price, extend that out in time, and the market drops down into that. That's a bullish order block, and it's taking out sell stops. So a high probability order block is when it takes out stops and returns down to the order block itself. The underlying pinnings of the market is it's bullish, so therefore down close candles that have a market move away from it and has a swing low just above it, like we do here. That's a confluence of specific things that make it high probability for the order block. The order block is the consecutive down close candles. All three of them make up the order block, but the sensitive price point is the high and the opening. So you can be a buyer at this high or at the opening price. The easiest one is using the high and allowing your stop to absorb any adverse price movement against you that would, if it was going to go back into, say, the opening price, you have to consider that when you're placing your stop. You can be buying at the high and use the low of all the consecutive down close candles. Your stop loss needs to be just below that. Does the market stay there very long once it trades into it? No. Leaves it, consolidates, rallies again, comes back down into another order block here. Trades lower, accumulates, and rallies again. Trades one more time, retracement, and then blasts off and attacks all the buy stops that were resting above these clean highs. Notice also, before the market starts to rally, it generally takes out some short-term swing low. This low took out this swing low. This low took out this swing low. This low took out this swing low. Each time, there's a dynamic rally higher. This swing low was taken out by this swing low, and it rallies higher. This swing low is taken out by that swing low. Not by much, but it's all it takes. And then it starts to move higher. So when there's a run on liquidity that's opposed to the underlying direction, in other words, if we're bullish on a market like this, get comfortable with the market reaching underneath lows and stop thinking that it's going to be breaking down entirely or reversing. Most of the time, you're going to find that it's taking those sell stops out and absorbing them to offer smart money buying opportunities at deep discount prices. Finally, we're looking at price on Monday and today, Tuesday. And I want you to notice how the market does what? It creates the low in London and then a continuation in the New York session. On Tuesday, it creates the low of the day and a continuation in New York, and it rallies up. It's consolidating in here. And where does the liquidity reside? Again, this blue line is that weekly line I drew out that was a clean level where the buy stops are. So the market's most likely going to draw up into that 139 big figure, 139.10, and the institutional level, 139.20, could potentially be traded to as well to make sure it really sweeps out all those buy stops. Now, what's the vested interest for the market to send price that high? Because smart money has bought down here, they bought down here, and they bought down here. Where do they want to get out at? At a high price. Who's willing to buy it from them at a high price? The buy stops resting just above that level here I noted on the weekly chart.